Fox Business Alert: bending spoons is stirring up the markets after debuting on the Nasdaq today. The private equity and tech hybrid company priced its IPO at $29 a share. They shot up after the open to as high as $42 and right now are at $37.49 for a gain of about 29%, holding on to pretty much a lot of that pop. The market valuation, $19.7 billion. The company's playbook focuses on acquiring and improving internet business cast-offs and forgotten brands. Joining me now, bending Spoons CEO Luca Ferrari. Luca, you spent the last several years hunting digital platform scrap heaps for down but not out companies, right? What led you to roll up those types of businesses? What did you see in them that the sellers did not?
Hi. Nice to be here. Thank you for having me. Well, we ultimately we win when we improve the business we acquire. The more we improve it, the better it is. We can pay a better price and we can deliver high returns. And so we look for businesses where that opportunity is, the greatest. And generally, we find that it's more likely that we can bring massive improvement to the technology, the user experience, monetization, if the business is not at the very peak of its hype and evolution. We have acquired more up-and-coming businesses as well as, like you said, more legacy businesses, but ultimately we just try to look for places where we can add value.
You spent in the past couple of years, about $4.5 billion to buy these orphans. Walk me through exactly what happens, say, for example, the week after you close an acquisition. What's the first call you make and what's the first thing you look to cut?
So we start by deploying a task force of experts. One of our key strengths and one of the key elements of what we call our platform is a very strong core team of roughly 700 software engineers, AI researchers, product designers, and we deploy a task force, maybe 50 or 60 of those people, into the business to study the business in detail and come up with a precise plan for how it can be improved. That can last a month or two. And then once that's done, we have a clear blueprint for what we want to do, the new org, the new technological layer, the features we want to deliver, the experiments we want to run to optimize monetization, and we get to work. Probably the most distinctive aspect of what we do is that those changes, those transformations are extremely deep, sweeping. I'm not aware of any serial acquirer that does it that way. We've built this shared platform, 50 plus proprietary technologies that run all of our businesses. So you can think of full deep integration, a core team that moves fluidly across all of these businesses. It takes a long time. It's a lot of effort. We can't do it over 50 acquisitions each year, but the ones we do, we try to do as well as we can, and it's been quite successful for us.
We are looking at a whole bunch of your product portfolio names in here, and some of them we recognize, as you said, AOL, for example. I want to talk a little bit about AOL, because you bought it for in 2025, about $1.5 billion. Steve Case, who founded it, I saw he tweeted today. He founded it and later sold it to Time Warner for $182 billion. I mean, you clearly have gotten it for a lot less. But he tweeted today, deja vu all over again. AOL went public in '92. First internet IPO at a market value of $70 million, rose to $160 billion 7 years later at a peak of the dot-com mania, then started a sad decline. But he goes on to say, glad to see AOL is now public again as part of Bending Spoons, hoping for the best. But I guess the question really becomes, it doesn't really have that many monthly active users today, 30 million. So whoever let it go is looking at this and saying, well, how do you fix that? So what is your answer to that?
We're very excited about AOL. I would say 30 million people using it monthly is a pretty big number. It's, to our knowledge, the 5th most used email product in the Western world. Also, the web portal has massive usage, a lot of loyalty, and the company has been pretty stable over the past many years. It's been on a slow growth, so it's a pretty healthy business. Precisely because it's been a little bit unloved for a long time, we see plenty of opportunity to inject a lot of enthusiasm, energy, innovation, science in the approach to running that business that we believe can benefit everybody involved. We are now in the process of overhauling the technological foundation. We're going to deliver a brand new ad tech stack these days. We're about to deploy that. We have rewritten the email product on desktop and mobile. We have planned a complete rewrite of the recommender system that chooses what you get to see on the web portal for the second half of the year. We have deployed a set of experiments to find the precise and optimized monetization setup. Of those 30 million monthly active users, only a tiny fraction have chosen to pay so far. So even if we, I don't expect it'll be a majority, but hopefully we can do a little bit better if we serve them with a better product over time. So it's not going to go back probably to the days Steve mentioned, but I think there is a bright future for AOL for sure.
You're going to raise subscription prices? I know, and you didn't really mention that as part of your playbook, but I know you guys, you limit the free tiers on some of these digital companies and you raise the subscription prices. You don't want to punish loyalty to some of these sites, do you?
We don't want to punish loyalty. We've actually lowered prices on multiple acquisitions where we gave away much more for free than was available before. On Meetup, for example, Meetup had been a paid-only product for multiple years, for as long as I can remember before we acquired it, and we then introduced a free tier where you can do quite a bit for free without ever paying. We just test different monetization setups, and sometimes we find that the optimal price point is higher than it was before. Sometimes we find that it's lower. But we just try to make sure these businesses are as successful as they can be. We've never sold a business. We will probably never sell one.
Wow.
So we have all the interests. Our incentives are to make sure that these businesses thrive 10 years from now. That's for sure.
As we finish up, I do want to ask you, because it's not exactly a crowded field in what you do, but there are other VMS or vertical market software models that have similar strategies where they acquire companies and they gussy them up. I mean, I'm thinking of Constellation Software, Arising Ventures, Com Capital. What's your moat when a well-capitalized rival comes in at an auction and you want the same thing? How do you make sure that you're the one who's going to get that acquisition?
Our history so far, at least the last 5 years, I don't believe there's haven't been a single case where we made an offer and then the business got sold to someone else. Every single time we made an offer, we either got the deal done or the seller chose not to sell. And in a highly competitive free market, you can only do that if you have a pretty significant moat. And that moat is what we call our platform, a team of 700 engineers, AI researchers, designers, product managers, who last year, to give you a sense of the level of talent there, we received 800,000 job applications. We only hired 286 people, so that's roughly 1 in 3,000. Super high talent density, a culture of high performance, rigor, collaboration. So that's a huge competitive advantage. It's taken us 13 years to build that, one person at a time. I guess it could be shortcut a little bit, but certainly not less than 6 or 7 years. Technologies, we've built over 50 proprietary tools that enable us to do so much more, so much better with fewer resources. That too requires a long time to build. At this point, we have accumulated a library of insights through over 3,000 A/B tests on product marketing monetization last year alone. All time, it's probably something like 10,000. Again, that takes a huge amount of time. And so we have this big advantage in both making the better decisions at the acquisition stage and then running these businesses, and also we integrate them super deeply. You mentioned Constellation Software. I don't work there, so you should ask them, but my understanding is that they keep these businesses pretty much completely separate, and that has advantages. It's very scalable. They can acquire 100 companies a year, and I think they do. We can't, but on the flip side, the advantage we have is that we can make them a lot more successful.
Luca, you're having success today. The stock is doing very nicely on its first day of trade. Luca Ferrari of Bending Spoons. See you next time. Thank you.
Thank you for having me.